Hi, my name is Carly Garner. I'm here with DeCarly Trading. We are a futures and options brokerage, a boutique futures and options brokerage. We're located in Las Vegas, Nevada, but we accept clients from all over the world. This is my contact information. If you have any questions, comments, concerns, you can reach me at this email address. Our website is decarlytrading.com, and I'm also on social media. If you happen to be on social media, check us on Facebook, Twitter, Instagram, even YouTube. I mentioned I'm in Las Vegas, Nevada. This photo was obviously taken there. This is my beagle, Frankie. So if you don't like pets or dogs, you probably want to stay away from my Instagram page. But to give you a little background, I am a broker and an author. I write a monthly column for Stocks and Commodities magazines here in the United States. I do contribute content and analysis to Jim Cramer's Mad Money as well as Bloomberg Television. And I write a couple of in-house newsletters that are distributed to our clients, our brokerage clients, free of charge. The Financial Futures Report and the DeCarly Perspective. It includes opinions, predictions, some of them right, some of them not right. Unfortunately, we don't have a crystal ball, but it also includes trading ideas. Today, what I think I'm going to focus on for this particular audience is diversifying a portfolio and hedging a portfolio. If you're interested in learning about futures and options, trading in a speculative manner, or even hedging, you can pick up a lot of this information in much more detail in my 3 books. These books are available at any major book outlet, but they're cheapest on Amazon. And before we get started, just want to make sure that we all understand there's a substantial risk of loss in trading futures and options. There's no guarantees of profit. Trading is not suitable for everybody. Today, we're going to talk about hedging a portfolio and diversifying, which is a little bit different. It's more on the investment spectrum than the trading spectrum. You should still also understand that there are never any guarantees in any financial product or process or market. The primary source of diversification from the futures market is often considered the precious metals, gold and silver. Some investors choose to purchase gold in bullion and store it in their basement or their garage or a safe somewhere. But the most efficient way to do it is through futures, and I'll talk about that in a minute. Some people also choose to use ETFs, but that too is very inefficient, and there's some benefit of trading futures as opposed to those other types of metals products. Gold is considered the quintessential commodity. Some people believe it's a good store of value in bad times. That's not always true. If you look at the current market environment in early 2022, gold did have a big rally early in the year, but it's given all of that back despite the fact that the stock market's struggling, bond market's struggling, and seems to be the world is going into a recession all at the same time. So it's not always a store of value in bad times, but it can be. It's also not always a quality long-term investment, but it can be a very good short-term investment. And it's not always an inflation hedge, which is what some people assume. We've had skyrocketing inflation in 2022, and unfortunately, gold has underperformed. Again, gold is not necessarily a safe haven either. It's considered all of these things. Conventional wisdom says it's these things, but these aren't always true. However, it's really good at diversifying a portfolio because the profits and losses on gold aren't necessarily correlated to other asset classes. They can be in the short run, but in the long run, they're not. And I'll show you that in a chart. Beyond 1980, owning gold for the long run has mostly been waiting and seeing. Here are some of the big rallies we've seen in the early 70s, the late 70s. But you can see in between, there are actually periods in which gold didn't do anything in a decade. So again, gold is a great diversifier. It's not a great buy and hold investment, or it hasn't been up till now. This is a chart of gold. It's a monthly chart, and it dates back over the last 20 years. And you can see in the long run, gold has moved higher overall. But there has been, for example, between 2011 and 2020, there was roughly a decade in which anybody that bought in 2011 would have had to wait a decade just to get their money back. So while it's in a long-term uptrend, it's not in the type of uptrend that you simply buy and forget about it, set it and forget about it. There are big corrections. Gold has a tendency to correct 20 to 40%, 25 to 40% when it does correct. So the declines can be very steep. But what that tells me is any really large dip in gold is probably a place to put some diversification in your portfolio, right? So anybody that did not chase the highs in 2011 but waited probably could have dollar cost average their way into gold anywhere from 1,300 to I think got down to about 1050. in the next couple of years. So again, not saying you buy and hold gold forever and it's going to make you rich. Absolutely not. But it will be a way to diversify a portfolio away from traditional investments. And this is what I mean by that. The yellow bars are monthly gold bars. So that's the performance in gold. The green bars are the S&P 500, which is the major stock index in the United States. You can see that gold doesn't only go up when stocks go up, nor does it only go up when stocks go down. In fact, it does its own thing, and that's a true diversifier. Some people were saying that Bitcoin was the new gold, and Bitcoin was the ultimate portfolio diversifier, but that is proven to not necessarily be the case. Bitcoin is highly correlated to the stock market. So anybody that decided to put Bitcoin in their portfolio in the hopes of diversification, we're probably sorry, because that's not how it worked out. But in the case of gold, that's exactly how it works out. So some people argue that it might make sense to have a small amount of your portfolio in gold just to kind of give yourself a chance to diversify. And again, the most efficient way to do that, in my opinion, is gold futures. Futures are extremely efficient because the futures contract represents delivery of the underlying asset when that futures contract expires. So it's tied to the price of gold. It's extremely liquid. If you're trading bullion, like gold bars or coins, it's really difficult to make a transaction. If you own the gold and you want to sell it, you're probably going to have to shave a couple $100 off of the value of that transaction just so that you can get the transaction done. In the futures markets, you can buy or sell gold with a very small bid-ask spread, so a tick or two. So it's not going to cost you any slippage when you buy or sell. You're not going to have to pay to store it. You're not going to have to pay to deliver it, all of those sorts of things. You just go along the futures contract, hang on and see what happens. Some people are scared to do that in the futures markets because of the leverage that's involved, but you can fully eliminate the leverage by funding the account in the contract value size, and I'll talk about that in a second. For those in the United States, gold futures are taxed more efficiently than ETFs or bullion. Also, gold futures trade around the clock, so you can buy or sell at any time of day, which is extremely convenient for those that are not in the United States, those overseas that are doing a bulk of their analysis and transactions during off hours in the US. Gold futures come in many sizes, and this is great for somebody that's using gold as a portfolio diversifier because they can choose how much they want to allocate towards that diversification tactic. The original gold contract is 100 ounces. That's $180,000 worth of gold. The margin required to hold that gold is only about $10,000. So if you had a $10,000 account, you could buy one contract. I'm not saying you should do that. That's highly speculative because your $10,000 margin requirement is merely there as a good faith deposit to cover any losses on the contract itself. But if your contract is worth $180,000 and gold moves up or down a small amount, you would either wipe out your $10,000 account or double it. And as you can see, that's very, very speculative. So the proper way to do it, if you're truly not speculating and you're truly diversifying your portfolio, would be to fully fund the account. If you had the means to do so based on your portfolio size, you'd put $180,000 into your futures trading account. You'd buy one single gold future, and that would basically represent $180,000 worth of gold with no leverage. If that's too large of an allocation, you can use a smaller contract. There's a 50 ounce, there's a 32 ounce, and there's a 10 ounce. A 10 ounce contract represents $18,000 worth of gold. So that's probably what a lot of portfolio diversifiers will use, is the smaller contract. So they'd basically put $18,000 to $20,000 in a futures account, and that takes away all of the leverage. So it's almost like holding 10 ounces of gold or roughly $18,000 worth of gold without any leverage. And you don't have to worry about things like transporting or storing, or when you go to sell it, you can sell it for exactly what the market price is, not $200 or $300 less just because you need to find a buyer. Another thing that we help clients to do, those clients that aren't speculators, if they're looking to just simply protect themselves or protect their investment portfolios, we help them to use the futures markets to hedge their stock portfolio. Or in some cases, we're dealing with farmers that are trying to hedge their agriculture business. But today we're going to talk about the stock portfolio hedging. Just to make sure we're all on the same page, hedging is the practice of taking an offsetting position in a related asset or security to reduce the adverse price risk of another asset. Actually, the futures markets were actually created for this exact purpose. They were created to shift risk from those that don't want the risk to speculators. Hedging is analogous to purchasing insurance. So again, it's shifting the risk of price from one person to another. Just like when you buy insurance, you're taking the risk off of your own liability and pushing it to your insurance company. So it's the same general idea. A perfect hedge doesn't really exist in reality, but if it did, it would eliminate all price risk. The reason I say there's no such thing as a perfect hedge is because there's slippage, there's transaction costs, there's all kinds of things that interfere with that. Markets are not perfectly efficient. Nonetheless, you can get a pretty perfect hedge in the futures market by selling a futures contract against your portfolio. So for example, if you had a portfolio of $225,000 worth of S&P 500 stock and you went short a futures contract at 45.30, you're basically locking that price in. If the futures price goes down, or if the price of the S&P, or aka the stock market, goes down, your futures hedge makes money and your portfolio loses money. And those numbers should wash out. For every dollar you're making on one hand, you're losing on the other, and vice versa. So it eliminates the price risks. You might ask why someone would do that. Well, in reality, most of the time you probably don't want a perfect hedge. Probably you want a partial hedge. But with a perfect hedge, you have no price risk, but you're also receiving dividends. So keep in mind that is one benefit. The dividends are still flowing in and you have no price risk. So if you want to just pause your portfolio, you don't want to sell, you don't want to get out, but you want to just hedge your price risk and see what happens, selling of futures is one way to do it. Now, not everybody has $225,000 worth of S&P 500 stock, but there are micro contracts that represent $22,000 worth of stock, depending on where the index is. There are also micro Dow futures, micro Russells. So you can, in theory, very efficiently and very effectively use the futures markets to hedge your stock portfolio. You really only want to hedge when prices are high, not when they're low. So when the market's in a trough, it's not the right time to hedge in most circumstances. You want to try to hedge when markets are a little overpriced. Some people like to purchase puts as insurance on their portfolio, and that's one way to do it. But the problem with just purchasing puts outright is they're very expensive and they only benefit the hedger if they're actually offset at a profit. And most people put the puts on, and even if the stock market sells off and their insurance or their protection pays off, they don't sell them. So they don't actually ever benefit. It was just actually a cost to their portfolio or a drag on their portfolio. This is just a quick example of how much money it would cost to constantly buy put options in the stock market to protect your portfolio. It can be very, very expensive. For example, when the S&P was at 41.50, if you wanted to buy a put in the S&P 500 with 60 days to go, so that covers the portfolio for 2 months, on roughly $225,000 worth of stock, it would have cost about $2,200. I'm rounding a little, but you get the idea. If you wanted to buy protection under $3,600, it would have cost you $1,100. So either way you go, that insurance is only going to pay off if the market sells off pretty sharply. Most of the time, the stock market goes up or trades sideways. So most of the time, that insurance that you purchase is just it's gonna give you comfort. You're gonna sleep better at night, but it's gonna be a cost to your portfolio and a drag to your portfolio. If you consistently did purchased options throughout time to renew every time they expired, you'd probably be giving up 4 to 6% of your S&P 500 gains every year. And guess what? The S&P on average only goes up 6 to 10% a year over the very long haul. So it's just not worth it to purchase puts, although that's the most common portfolio hedge there is. Here's maybe a different idea and maybe a better idea in my opinion. You can purchase those puts, but instead of paying for them out of your pocket, you can sell a call option to pay for them. That way you're using the market's money to buy your insurance. So over time, it's not so much of a drag on your portfolio. The opportunity cost of that is you would be giving up some upside gains. So for example, if using the exact same chart as before, if the S&P is at 4,500 and you want to make sure that you protect yourself just in case things roll back over and it gets ugly, you could sell a 46.50 call and then use the proceeds to buy a 42.50 put. That gives your portfolio protection on 225,000 roughly worth of S&P stock below 42.50. And you didn't have to pay for it. The only thing is, if the S&P continued to rally and it rallied above 46.50, your portfolio would be gaining in value, but you would be losing on your hedge. That's the opportunity cost. You're just giving up gains above a certain price. Now, keep in mind, there are micro options, so you can do this exact same thing with a much smaller amount. For example, if you had a $20,000 portfolio you wanted to hedge, you could do this strategy with the micro options. And as a brokerage that specializes in futures and options, we can help you put together that sort of a strategy. We offer online trading, but if you want to do everything on your own, but if you want broker assisted, if you want somebody to coach you and help you, we offer that as well. So just to kind of recap, precious metals are a highly speculative vehicle, but they can also be a portfolio diversifier. You can trade or hedge within your means using futures and options by simply overfunding your account. If you're trading a micro gold option, a micro gold futures, and your account is worth about 18,000, you have no leverage. You're simply buying about $18,000 worth of gold in an efficient manner, in a liquid manner, and in a marketplace you can buy or sell 24 hours a day, or actually 23 hours a day to be exact. Again, we can also help you with futures market hedging of your portfolio. So I gave you some example in the S&P 500, but we can do the same thing for treasuries if you want to hedge your interest rate risk. We can also do the same thing for energies if you want to hedge your energy risk, whether it's crude oil or natural gas. So the futures markets were created for hedging, and most people are speculating in the futures markets, but they are created for hedging purposes, and we can help you do that. We are DeCarly Trading. You can visit us at decarlytrading.com. I appreciate your support. If you're interested in learning some of the more advanced option strategies for speculating or hedging, you can visit our book website. It's tradingcommodityoptions.com. And once again, here's my contact information. I'd love to hear from you if there's anything that we can do for you. We'd love to be there. Thank you.